So what exactly is ICT methodology? Let me explain it in the simplest way possible. ICT stands for Inner Circle Trader, and it was developed by a trader who figured out something that most people never realize. The markets aren't random. They're not driven by emotions or news events like most people think. Instead, the markets are controlled by algorithms, computer programs that banks and institutions use to buy and sell massive amounts of currency, stocks, and other assets. Now, here's the key insight. These algorithms follow predictable patterns. They have to move money in and out of the market in specific ways. And if you know what to look for, you can actually predict where price is going to go next. Think of it like this. Imagine you're watching a movie, but instead of just watching the actors on screen, you can see the script they're following. That's what ICT methodology does. It reveals the script that the market follows. The ICT method teaches you to think like an institution, to see the market from their perspective, and to position your trades alongside theirs instead of against them. It's not about indicators or complicated math. It's about understanding the logic behind price movement and using that logic to your advantage.
Here's something that might shock you. 90% of all market movement is controlled by computers, not humans. Let me explain what this means for you as a trader. Back in the old days, markets were driven by people calling brokers, shouting on trading floors, making emotional decisions based on news and gut feelings. Those days are over. Today, massive banks and financial institutions use sophisticated computer programs called algorithms to execute their trades. These algorithms can process millions of data points in milliseconds and make trading decisions faster than any human ever could. Now, you might think this makes trading impossible for regular people like us, but actually, it makes it easier if you know what to look for. You see, algorithms are predictable. They follow rules and patterns. Unlike humans, they don't get emotional or make random decisions. They execute the same strategies over and over again. The ICT methodology is specifically designed to recognize these algorithmic patterns. Instead of trying to fight against these massive institutions, we learn to identify when they're about to make a move, and we position ourselves to profit alongside them. It's like being able to see the playbook that the winning team is using. Once you know their strategy, you can predict their next move and position yourself accordingly. This is why ICT trading works so well. We're not gambling or guessing. We're reading the institutional footprints that these algorithms leave behind.
Now, I want to be completely honest with you about learning ICT methodology. This isn't a get-rich-quick scheme, and it's not something you'll master overnight. ICT trading is a skill, like learning to drive a car or play an instrument. And like any valuable skill, it requires proper education and practice. The creator of ICT methodology has put together 3 foundational course series that you should study before diving deeper into advanced concepts. First is the Market Maker series. This teaches you how the big institutions think and operate. You'll learn about their psychology, their constraints, and most importantly, their strategies. Second is the Precision Trading Concepts series. This focuses on timing and execution, how to enter and exit trades with pinpoint accuracy. Third is the Sniper series, which teaches you patience and discipline, how to wait for the perfect setup instead of overtrading. Now, I know what you're thinking. That sounds like a lot of work. And you're right, it is. But here's the thing. Every successful professional trader has invested time in proper education. The ones who try to skip this step are the ones who end up losing their money. The good news is that this presentation will give you a solid overview of the key concepts, so you'll know exactly what to focus on when you dive deeper into your studies.
All right, now we're getting to the meat and potatoes of ICT methodology, the 4 market conditions. Here's a revolutionary concept that will change how you see the markets forever.
Every single price movement, on every chart, in every market, falls into one of just 4 categories. That's it. 4 patterns. Not hundreds of indicators, not dozens of strategies. Just 4 simple market conditions that repeat over and over again. These 4 conditions are consolidation, expansion, retracement, and reversal. Think of these like the 4 seasons of trading. Just like nature cycles through spring, summer, fall, and winter, markets cycle through these 4 conditions in predictable ways. Once you learn to identify which condition the market is currently in, you'll know exactly what type of trading opportunity to look for. You'll never again stare at a chart wondering what's going to happen next. Instead, you'll be able to say with confidence, the market is in consolidation right now, so I'm going to wait for an expansion. Or, we just had an expansion, so now I'm looking for either a retracement or a reversal. Over the next few slides, we're going to break down each of these 4 conditions in detail. Get ready to see the markets in a completely new way.
Let's start with consolidation, and I'm going to use a simple analogy to help you understand this concept. Imagine you're watching a tennis match, and the ball is being hit back and forth between the 2 players. It's not going anywhere in particular, just bouncing from one side of the court to the other. That's exactly what consolidation looks like in the markets. During consolidation, price moves sideways between 2 clear levels, what we call support and resistance. It's like the market can't decide which direction it wants to go, so it just bounces back and forth. Now, here's what's really happening behind the scenes. The big institutions are building up their positions. They're accumulating large amounts of currency or stocks, but they have to do it carefully. If they tried to buy or sell everything at once, they would move the price too much and hurt their own profits. So instead, they spread their buying and selling over time, creating this sideways movement. It's like filling up a gas tank. You can't do it all at once, so you add a little bit at a time. The key thing to remember about consolidation is that it doesn't last forever. It's like a spring being compressed. The longer it goes on, the more energy builds up, and eventually that energy has to be released. Consolidation happens most often during the Tokyo trading session, when the markets are quieter. This makes sense because there's less trading volume, so it's easier for prices to move sideways rather than trending strongly in one direction. When you see consolidation on your charts, don't try to trade it. Instead, be patient and wait for the breakout that's coming.
Now let's talk about expansion. This is where the real money is made in trading. Remember our tennis analogy? Well, expansion is like one of the players suddenly hitting a powerful serve that the other player can't return. The ball doesn't bounce back and forth anymore. It goes strongly in one direction. Expansion happens when price breaks out of consolidation and moves quickly in one direction. This is the market's way of releasing all that built-up energy we talked about. Here's what's really happening. The institutions have finished building their positions during consolidation, and now they're ready to push the market in their favor. It's like a dam bursting. All that pressure gets released at once. In Forex trading, a typical expansion might be about 20 pips. That might not sound like much, but when you're positioned correctly, those 20 pips can represent significant profit. Now here's where it gets really interesting. Just before an expansion happens, institutions place what we call order blocks. Think of these like footprints that the big players leave behind. An order block is simply the last candle that moved in the opposite direction before the expansion began. If price is about to shoot up, the order block is that last down candle. If price is about to fall, the order block is that last up candle. Why is this important? Because institutions often come back to these order block levels to add more to their positions. It's like they're saying, hey, this level worked for us before.
Let's use it again. So when you see an expansion, don't chase it. Instead, wait for price to come back to that order block level. That's where your next trading opportunity might be.
Let's move on to retracement, and I'll use another simple analogy to explain this concept. Imagine you're climbing a mountain. You don't just walk straight up to the top. That would be impossible. Instead, you climb for a while, then you rest, then you climb some more, then you rest again. The resting periods are like retracements in the market. A retracement is when price takes a temporary step back against the main trend. If the overall trend is up, a retracement is a temporary move down. If the trend is down, a retracement is a temporary move up. This is completely normal and healthy market behavior. Even the strongest trends need to pause and catch their breath before continuing. Now, here's what the institutions are doing during retracements. They're looking for better prices to add to their positions. It's like getting a discount at your favorite store. They want to buy more at a better price. During retracements, we look for what we call POIs, points of interest. These are specific levels where institutions are likely to step back in and continue pushing the market in the main direction. The most common POIs are fair value gaps and liquidity voids. A fair value gap is simply an area where price moved too quickly, leaving a gap on the chart that hasn't been filled yet. Think of it like a pothole in the road. Eventually, someone has to come back and fill it. We also use Fibonacci levels to identify potential retracement levels. The most important ones are 61.8%, 70.5%, which we call the optimal trade entry, and 79%. Retracements happen most often during the New York trading session. This makes sense because that's when there's high volume and lots of activity, creating the perfect environment for these temporary pullbacks. The key with retracements is patience. Wait for price to reach one of these key levels before considering a trade. Now we come to reversals, and this is where things get really exciting for traders. Let me use a car analogy to explain this. Imagine you're driving down a highway, and suddenly you see a sign that says, "Road closed, detour required." You can't keep going in the same direction anymore. You have to completely change course. That's what a reversal is like in the markets. A reversal happens when the prevailing trend completely changes direction. An uptrend becomes a downtrend, or a downtrend becomes an uptrend. It's not just a temporary pause like a retracement. It's a complete change of direction. Reversals often happen around what we call liquidity pools. Think of these like honeypots that attract bears. Liquidity pools are areas where lots of stop losses are clustered, usually just above old highs or just below old lows. Here's what happens. Institutions know exactly where these stop losses are located, so they push price just far enough to trigger these stops, grab all that liquidity, and then reverse the market in the opposite direction. It's like they're harvesting all the money from the traders who placed their stops in obvious places. We also look for failed breaks of structure and double bottoms or double tops as signs of potential reversals. These patterns tell us that the institutions have tried to push price further, but couldn't, so they're probably going to change direction. Reversals are most common during the London trading session, when there's high volume and lots of institutional activity. Here's the key point. Reversals can be the most profitable trades, but they're also the riskiest. You're essentially betting that the entire trend is going to change direction. This requires careful analysis and proper risk management.
Now let's put it all together and see how these four market conditions work as a complete cycle. Think of the markets like breathing. There's an inhale and an exhale, and this pattern repeats continuously. The market inhales during consolidation, gathering energy, then exhales during expansion, releasing that energy. Here's how the cycle typically works. The market starts in consolidation, building up pressure like air in a balloon. Then comes expansion. The balloon pops and price moves strongly in one direction. After the expansion, the market has two choices. It can either retrace, take a temporary step back before continuing in the same direction, or reverse, completely change direction. If it retraces, it's like the market is catching its breath before running further in the same direction. If it reverses, it's like the market is saying, "Okay, I've gone far enough in this direction, time to go the other way." After either a retracement or a reversal, the market will eventually go back into consolidation, and the cycle starts all over again. Understanding this cycle is crucial because it tells you what to expect next. If you see consolidation, you know expansion is coming. If you see expansion, you know either retracement or reversal is next. This isn't random, it's the natural rhythm of the markets. Just like you can predict that winter will follow fall, you can predict that expansion will follow consolidation. The key is learning to identify which phase of the cycle you're currently in, and then positioning yourself for what comes next.
All right, now we're going to learn about the tools that professional traders use, what I call the institutional order flow tools. Think of these tools like a detective's forensic equipment. Just like a detective can examine a crime scene and tell you exactly what happened, these tools allow us to examine a chart and see exactly where the institutions have been active. We have four main tools in our toolkit: order blocks, fair value gaps, liquidity pools with stop runs, and equilibrium levels. Each of these tools corresponds to one of the four market conditions we just learned about. It's like having the right tool for the right job. You wouldn't use a hammer to fix a watch, and you wouldn't use the wrong trading tool for the wrong market condition. Order blocks work best with expansion. Fair value gaps work best with retracements. Liquidity pools work best with reversals. And equilibrium works best with consolidation. Now, here's the beautiful thing about these tools. They're not based on complicated mathematics or subjective interpretation. They're based on the actual footprints that institutions leave behind when they trade. It's like following a trail through the forest. Once you know what to look for, the path becomes obvious. Over the next few slides, we're going to explore each of these tools in detail, so you'll know exactly how to use them in your own trading. Let's dive deep into two of our most powerful tools, order blocks and fair value gaps. First, let's talk about order blocks. Imagine you're at a busy restaurant and there's one table where all the VIP customers sit. That table becomes significant because of who sits there. Order blocks work the same way. They're significant because of who traded there. An order block is simply the last opposing candle before a strong move. If price shoots up strongly, the order block is that last down candle before the move began. If price falls strongly, the order block is that last up candle. Why are these important? Because this is where the institutions placed their large orders. It's like they left their business card at that level. And just like VIP customers often return to their favorite table, institutions often return to these order block levels to place more trades. Now, fair value gaps are completely different, but equally powerful. Think of a fair value gap like a pothole in the road. When price moves too quickly, it creates gaps or potholes in the chart that eventually need to be filled. These gaps occur when there's an imbalance between buyers and sellers. Price moved so fast that it skipped over certain price levels without giving everyone a chance to trade there fairly. The market has a natural tendency to return to these gaps and fill them.
just like a city eventually fills potholes to smooth out the road. Fair value gaps are particularly useful during retracements. When you see a strong move followed by a pullback, look for fair value gaps in the path of that pullback. These often act like magnets, drawing price back to fill the gap. The key with both order blocks and fair value gaps is patience. Don't chase price when it moves away from these levels. Instead, wait for price to return to these areas. That's where your trading opportunities are. Now let's explore the other two crucial tools: liquidity pools with stop runs and equilibrium levels. Liquidity pools are like fishing holes where all the fish gather. In trading terms, they're areas where lots of stop losses cluster together, usually just above obvious highs or just below obvious lows. Here's what happens. Most traders place their stops in obvious places. If they're buying, they put their stop just below the recent low. If they're selling, they put their stop just above the recent high. This creates clusters of stop orders, our liquidity pools. The institutions know exactly where these pools are located, and they use them like ATM machines. They push price just far enough to trigger all these stops, collect that liquidity, and then often reverse price in the opposite direction. It's like they're saying, "Thanks for the free money," to all the traders who placed their stops in obvious places. A stop run is when this actually happens. Price briefly spikes above a high or below a low to grab these stops, then quickly reverses. On the chart, it looks like a spike or a wick that gets immediately rejected. Now, equilibrium is a completely different concept. Think of it like the center of a seesaw. No matter how far the seesaw tips in one direction, it always wants to return to the center. That's equilibrium. In a consolidation range, equilibrium is simply the midpoint, the 50% level between the high and low of the range. Price has a natural tendency to gravitate toward this level, like a magnet. Equilibrium levels are particularly useful for identifying where expansion might begin. Often, price will return to the equilibrium of a range before breaking out strongly in one direction. The key with liquidity pools is to avoid placing your stops where everyone else does. And with equilibrium, remember that price is always trying to return to balance. Here's something that most traders completely overlook. The time of day you trade can make a huge difference in your success rate. The Forex market is open 24 hours a day, but that doesn't mean all hours are created equal. Different trading sessions have different characteristics, and understanding these can give you a significant edge. Let me break this down for you. The Tokyo session is like the quiet hours at a library. There's not much activity, volume is low, and price tends to move sideways. This is prime time for consolidation patterns. It's not the best time to look for big trending moves, but it's perfect for identifying ranges that might break out later. The London session is like rush hour in a busy city. There's lots of activity, high volume, and this is when many reversals happen. The big European banks are active, and they often push price to grab liquidity before reversing direction. The New York session is like the afternoon shift. There's good activity, but it's more about continuation than initiation. This is when retracements often happen. Price might pull back against the main trend before continuing in the original direction. Now, here's the key insight. Different market conditions favor different sessions, and different sessions favor different market conditions. It's like a dance where everyone knows their part. If you're looking for consolidation patterns, focus on Tokyo. If you want to trade reversals, pay attention to London. If you're waiting for retracements, New York might be your best bet. Volume tells the story too. High volume during expansion confirms the move is real. Low volume during consolidation is normal and healthy.
Now we come to one of the most important concepts in all of trading: confluence. This is what separates successful traders from those who struggle. Think of confluence like a criminal investigation. A detective doesn't arrest someone based on just one piece of evidence. They need multiple pieces of evidence that all point to the same conclusion. Trading works the same way. Confluence means having multiple factors aligned to support the same trading decision. Instead of relying on just one signal, you wait for several different factors to confirm each other. Here's how it works in practice. Let's say you identify a consolidation that's ready to break out. That's factor number 1. You notice there's an order block at a key level. Factor number 2. You see that we're entering the London session, which favors breakouts. Factor number 3. And you observe that there's a fair value gap that price might target. Factor number 4. When multiple factors like these align, you have confluence, and that's when high probability trading opportunities emerge. The more factors that align, the higher your probability of success. It's like having multiple witnesses all telling the same story. You can be much more confident in your conclusion. Here's what you should look for in a confluence setup. First, identify the current market condition. Second, choose the appropriate ICT tool for that condition. Third, check the session timing. Fourth, look for additional confirming factors like Fibonacci levels or volume patterns. Remember, in trading, patience pays. Don't take trades just because you're bored or eager to make money. Wait for confluence. Wait for multiple factors to align in your favor. The best traders take fewer trades, but each trade has multiple reasons supporting it.
Alright, let's put everything together with some practical examples of how to apply ICT methodology in real trading situations. Example number 1, the consolidation breakout setup. You see price consolidating between clear support and resistance levels during the Tokyo session. You identify the equilibrium, 50% level, of this range. As we move into the London session, you wait for price to return to equilibrium and then watch for a strong breakout. If price breaks above resistance with conviction, you look for an order block to enter on a pullback. Example number 2, the retracement entry. Price has made a strong upward expansion, creating a fair value gap along the way. During the New York session, price starts to retrace. You use Fibonacci levels to identify potential turning points, specifically the 70.5% level, which is the optimal trade entry. When price reaches this level and fills the fair value gap, you have confluence for a long entry. Example number 3, the reversal play. Price approaches an old high where you know stops are clustered. That's your liquidity pool. During the London session, price spikes above the high, triggering stops. That's your stop run, but then immediately reverses with a strong down candle. This creates a fair value gap and confirms the reversal. You enter short on the next retest of the broken level. The key in all these examples is patience and confirmation. You don't just see one signal and jump in. You wait for multiple factors to align. You confirm the setup with price action, and then you execute with proper risk management. Remember, the goal isn't to catch every move. It's to catch the high probability moves with confidence. Let me wrap up this presentation by talking about the mistakes that derail most traders and how you can avoid them. Mistake number 1, overtrading. This is the biggest killer of trading accounts. Just because you understand ICT methodology doesn't mean you should trade every setup you see. Quality over quantity, always.
It's better to make 5 great trades per month than 50 mediocre ones. Mistake number 2, chasing price. When you see a strong move happening, your emotions will scream, "Get in now before you miss it." Resist this urge. If you missed the initial move, wait for the pullback or the next setup. There's always another opportunity coming. Mistake number 3, ignoring session timing. Trading a reversal setup during Tokyo session is like trying to surf during low tide. The conditions just aren't right. Respect the session characteristics we discussed. Mistake number 4, lack of confluence. Taking trades based on just one factor is gambling, not trading. Always wait for multiple factors to align before risking your money. Now, here's how to develop consistency. Start with just one setup type. Don't try to master everything at once. Pick consolidation breakouts, for example, and become an expert at that one pattern before moving on to others. Keep a detailed trading journal. Record not just your wins and losses, but why you took each trade. What was your confluence? What session was it? What market condition? This data will help you identify your strengths and weaknesses. Practice on demo accounts first. Paper trading might be boring, but it's much better than losing real money while you're learning. Finally, remember that trading is a skill that takes time to develop. Be patient with yourself. Focus on the process rather than the profits. And never risk money you can't afford to lose. The ICT methodology works, but like any powerful tool, it requires practice and discipline to use effectively. Stay committed to your education, and the results will follow.
Thanks so much for watching today's video. I really appreciate you taking the time to tune in. If you enjoyed it, make sure to follow me across all platforms so you don't miss future content. Down in the description, you'll find links to the brokers I personally use, some backtesting software I recommend, and of course, our free Discord community where you can connect and learn alongside other traders. I'll leave you with this video's verse. The Lord will fight for you, and you shall hold your peace. Exodus 14:14. God's power brings victory where our strength falls short. And as always, remember, strive for progress, not perfection. I'll see you all in the next one. God bless.